Chapter 11, Financial Accounting, Liabilities, Bonds Payable, Part 3 of 3. It's important that students understand Part 1, the terminology, and the new languages related to bonds, as well as Part 2, where we talk about the transactions recorded when someone sells a bond at face, premium, and a discount, before you start trying to understand this third part, which is the amortization of the premium or the discount. So the first thing we want to talk about is amortizing a bond discount or a bond premium. We're going to start with amortizing a bond discount. So every time interest is paid, the cash is mailed to the bondholders. They get a flat amount. It's guaranteed. It's in the contract. If the interest rate is 12% on a $1,000 bond, then one bondholder with one bond is going to receive $60 every 6 months. It doesn't matter if they paid a premium or a discount for this bond. However, the bond issuer, the company that sold the bond, has to work on modifying the interest expense to reflect the passage of time related to the discount. So these discounts and these premiums have to be reduced down to zero over the life of the bond. When bonds are issued at less than their face value or more than their face value, this premium or discount is amortized, and then at the maturity date, the face amount is repaid. So it's a bit tricky. Remember, in a bond premium, for example, the bond is sold for more than the face value, and this premium has to be amortized. Amortizing just means that we're going to allocate the cost over the life of the bond. So stay tuned as we go through this piece by piece because it's a difficult concept to understand. First, let's talk about the theory, and that is that whenever you amortize a bond premium or a bond discount, you're modifying the interest expense recorded. The cash for interest will be the same, but you're modifying the interest expense recorded by the company. This is because a bond premium or a bond discount occurred because the interest wasn't matching market or the effective interest rate. And so therefore a premium reduces interest expense and a discount increases interest expense. Now try to make some sense of that. It is intuitive and it does make sense when you think about it. The reason a bond is sold at a premium is because they were offering this fantastic interest rate. And so the bond issuer is kind of frustrated that they paid a high interest rate, but they get a premium in to help reduce the actual interest expense. Similarly, if a bond is issued at an interest rate that's not good, then the bond purchasers are saying, nope, not giving you full price, I'll take it at a discount. And so the bond issuer is finding that they didn't even get $1,000 and yet they're having to pay interest on $1,000. And so this discount increases their interest expense as they amortize this discount. Now, this is an important concept to understand the equalizing nature of the markets, and it's an important business concept. Recording these transactions for financial accounting helps the intro business student understand what. There are two methods of computing this amortization. We'll be discussing straight line, which is just easy, even calculation. There's also the effective interest method, which is probably a better method, but it's going to be discussed in upper level in accounting classes because it's much more difficult. Straight line method is only allowed by GAAP if it's not materially different than the effective interest method, but most companies would make this amortization calculation using the effective interest method. Let's talk about then amortizing a bond discount. The entry is to take that discount that's been recorded, and again, if you don't recall, go back to part 2 of 3, taking that discount that has a debit balance and amortizing it. And in doing so, it's making the interest expense go up. So it can either be done separately or, as we're going to do in this chapter, we're going to do it combined. We're going to combine the amortization of the discount as well as the calculation of the cash interest that's paid. And note that it's going to make the interest expense go up. Here's our assumption. Western Wyoming Distribution issues a bond at $100,000 face with an interest rate of 12%. But of course, with a market rate going on now of 13%, Western is aware that they're not going to be able to sell their bond at face. So because their interest rate is too low, they're going to have to issue at a discount. This discount in this calculation is $3,594. This is similar to the exact same problem in part 2 of 3. And since it's a 10-year bond, since it's a 5-year bond, that's 10 periods. So let me talk back through that hiccup again. This is a 5-year bond paying semi-annual interest. That means they're going to pay interest 10 different times. So they're going to take this $3,594, spread it out straight line, amortize it or spread it out, allocate it, $359.40 every 6 months when they make that interest payment. So this combined entry is going to look like this. The cash that the bondholders receive is $6,000 on that $100,000 bond. Each individual bondholder gets paid $60, even though they receive the bonds at a discount. The discount, though, is being amortized $359.40, which means the interest expense has gone up. So interest expense is now reflecting a higher interest rate, which is really what the bondholders were looking for in the first place and why there was a discount in the first place. Take some time to get this to be intuitive for you. Again, we have a 10-period interest payment period. This is going to happen 10 times over the next 5 years before we repay the bond. And the discount is going to be allocated over those 10 periods, $359.4 per period, and interest expense will go up with a discount. It's always a really good question that I ask on an exam, and that is, when you amortize a bond discount, does interest expense increase or decrease? Let's then look at what happens to the premium. We have a bond from the Northern Idaho Transportation Company issued, and it's a $100,000 bond that pays 12% interest similarly, but the market rate of interest on similar bonds, 5 years with this issuance, is 11%. So Northern Idaho Transportation could be a little frustrated at the fact that they have issued a bond paying higher interest rate than they had to, but they get a premium for it. So they're pleased with the fact that they're going to get some extra cash in to help offset the fact that they're paying higher interest than what the market is asking for. Okay, because this contract rate is more, the bonds are selling at this premium. The premium in this example is $3,769. Debit cash, $103,769. Credit bonds payable, and we have an unamortized premium right now of $3,769. The carrying value of this bond is $103,769. And we will slowly whittle down that carrying value as we allocate it and apply it to reduce our interest expense each interest payment period. I want to take a quick pause here to remind you that the fact that this bond is selling at 103.769 is not something you will be calculating. It's something that will be provided for you in the problem. So, like a bond discount, the premium has to be amortized, and this premium amortization is going to decrease the contract rate that's paid, and therefore interest expense is going to be lower than the cash that they pay out. So let's look at how this works. We've got interest expense and the premium added together to equal the amount of cash when we have a combined calculation, or if we choose, we can amortize that interest expense separately. And different companies will do it different ways. Different students will do it different ways. The end result is the same whether you do a combined entry or not. So we're going to do the combined entry with this example. $3,769 is our premium, 5 years. Semi-annual interest means 10 periods, 376.90 is going to be how much we amortize or spread out to offset the interest expense that Northern Idaho is paying, because their interest expense is just a little bit higher than they had anticipated because the effective rate dropped. So here we go. The $6,000 is still being paid. Keep this in mind. The interest is paid on the contract of the bond. That's $6,000. That's what the bondholders receive. Each bondholder gets $60. But the company amortizing this premium at $376.90 a period is only going to have to record $5,623.10. That's because this interest expense has been reduced by the fact that they got in a premium on this bond. I like to think of it this way. The cash has been paid of $6,000, and the company could be frustrated by the fact that they're paying a 12% interest instead of 11%, which is what similar companies are paying, except they got in this nice little stash of money of $3,769 that they can use to sort of offset their interest expense over the next 5 years. And so that makes the effective interest expense recorded and matched on their income statement lower than the amount of cash that they paid. This ends Chapter 11. In the back of Chapter 11, there are some good examples of what the financial statement disclosure would look like. I hope you'll take a minute to look at that. But most importantly, the pencasts and the videos to walk through a problem step by step, as well as homework that's going to have you calculating some of these problems. It's very theoretical, very conceptual. This chapter surprises a lot of students because they don't expect accounting to have so much theory in it, but it is intuitive and logical theory. And I hope that as you go back through and study this chapter, you find it to be so. Please, as always, let me know if there's any way that I can assist.